Derek and Ryan walk into their HR offices on the same day. Derek and Ryan, same age, 28. Same salary, $75,000. Same level of financial responsibility. Same $500 a month they've decided to put toward retirement. Derek and Ryan. The only difference? Where that money goes. One opens a Roth IRA. The other maxes out his 401k. Derek and Ryan, 37 years later, Derek and Ryan decisions will produce wildly different outcomes. Not because one account magically grows faster. The market doesn't care which account type your money sits in. The difference comes from something most people never stop to think about. When does the IRS collect their cut? That single question, today or later, is what actually separates these Derek and Ryan accounts. And depending on your answer, the gap in real, spendable wealth could be 6 figures. Let's walk through it. Meet the two guys. Derek goes the 401k route. Derek's employer matches 50 cents on every dollar he contributes, up to 6% of his salary. That means on top of his $500 monthly contribution, Derek's company drops in an extra $187. Derek's total monthly retirement input, $687, and $187 of that costs him nothing. Better yet, Derek's $500 comes out of his paycheck before taxes hit it. At a 22% federal tax bracket, that $500 contribution only actually reduces Derek's take-home by about $390. The government essentially subsidizes the rest. Day 1, Derek looks like a genius. Ryan goes the Roth IRA route. No employer match, no upfront tax break. Ryan $500 comes out of money he's already paid taxes on. Ryan contributes the annual maximum, $7,000 a year, and feels it a little more every month because there's no immediate relief. Day 1, Ryan looks like he's making the harder choice. And if you're keeping score right now, you'd say Derek is winning. You'd be right. For now, the silent business partner. Here's what almost nobody talks about when comparing these accounts. Every dollar inside Derek's 401k, his name is the IRS, and he owns somewhere between 22% and 37% of everything in that account. Exact percentage TBD, because Derek doesn't know yet what tax rates will look like in 2055. Every dollar inside Ryan's Roth IRA. No silent partner. The IRS already collected at 22% when Ryan was 28, earning near the beginning of his career. Whatever grows from here belongs entirely to Ryan. A 401k gives you a tax break now and sends you a bill later. A Roth IRA sends you a bill now and gives you a tax break later. The whole debate lives inside that trade-off. Everything else is just math. Year 10. The scoreboard. Let's check in a decade later. Derek's 401k. Contributions, his plus employer match, approximately $82,440. At 7% average annual growth, roughly $114,000. Ryan's Roth IRA. Contributions, his only, $60,000. At 7% average annual growth, roughly $86,000. Derek is ahead by $28,000. The employer match gave him a genuine head start, and compounding has amplified it. But here's what the raw balance doesn't show. Ryan's $86,000 is entirely his. No tax liability, no strings. If he wanted to withdraw it at retirement, every dollar shows up in his bank account. Derek's $114,000 has a bill attached. At a 24% effective withdrawal rate, that $114,000 is really worth closer to $86,640 after taxes. Suddenly, they're almost even. And there's one more thing the balance comparison misses. Flexibility. Ryan can pull out the money he personally contributed, not the earnings, just his original deposits, at any time for any reason, with zero taxes and zero penalties. It's not something he plans to do, but it's there. Derek can't do that. An early 401k withdrawal before age 59 and a half means income taxes plus a 10% penalty. That's an expensive emergency fund. The career plot twist. Now let's fast forward the story. Derek gets promoted, then promoted again. By his mid-50s, he's earning $140,000 a year, a genuinely great outcome. His career went exactly the way it was supposed to. But this success creates an unexpected complication. Every dollar in his 401k will be taxed at his income tax rate at the time of withdrawal. If Derek retires at 65 with $1.4 million and pulls out $80,000 a year to live on, the IRS treats that $80,000 as ordinary income. He'll owe federal taxes on it. He may find himself in a higher bracket than he anticipated. And starting at age 73, the government doesn't wait for him to decide when to withdraw. Required minimum distributions, RMDs, kick in. The IRS calculates a minimum amount Derek must pull out each year based on his balance and life expectancy. In a strong market, those forced withdrawals can push him into brackets he didn't plan for, increase taxes on his Social Security benefits, and even trigger higher Medicare premiums. Derek did everything right, saved consistently, took the match, let it grow. But the account structure means he doesn't fully control his tax situation at retirement. The government has a schedule, and they're keeping it. Ryan's retirement. Ryan at 65 faces a completely different set of decisions. His Roth IRA has no RMDs. None. He doesn't have to touch a single dollar if he doesn't want to. He can let the whole thing keep growing, pass it to his children, or withdraw exactly what he needs when he needs it. When he does withdraw, it's all tax-free. His $80,000 a year in retirement is $80,000 that actually hits his account. Not $80,000 minus whatever the current rate happens to be. The number on his statement is the number he gets to spend. Final scoreboard at 65. Derek's 401k, $687 per month for 37 years at 7% growth. Gross balance, approximately $1,620,000. After taxes at a blended 24% withdrawal rate, approximately $1,231,000. Ryan's Roth IRA, $500 per month for 37 years at 7% growth. Balance, approximately $1,178,000. After taxes, $1,178,000. Nothing owed. Derek wins on paper. Ryan wins in his wallet. The employer match is literally the only reason Derek comes out ahead on gross balance. Strip that away, and the Roth, on an equivalent contribution basis, wins clearly once taxes enter the picture. What nobody tells you in the highlight reel, required minimum distributions are a real problem. The government doesn't let 401k money sit forever. RMDs, starting at 73, can force withdrawals larger than you actually need, compressing your tax bracket at exactly the wrong time. Tax rates are unpredictable. When you contribute to a traditional 401k, you're betting your future tax rate will be lower than your current one. That's sometimes true, but consider the historical range. The top federal rate hit 70% in 1980 and exceeded 90% in the 1950s. Nobody knows where it lands in 2050. A Roth locks in today's rate. That's not nothing. Roth IRAs have income limits. If your income climbs above $146,000, single filer 2024 figures, your ability to contribute to a Roth phases out. High earners have workarounds, the backdoor Roth conversion. But it adds complexity. The 401k has no income ceiling. The match is irreplaceable. No investment strategy on the planet guarantees a 50% or 100% return in year one. Walking away from a full employer match to prioritize a Roth IRA is one of the most expensive financial decisions a person can make. The match always comes first. So what's the right answer? It's not either slash or. It's a sequence. Step 1. Contribute to your 401k up to the full employer match. This is non-negotiable. Free money with a guaranteed return beats every other financial move available to you. Capture it completely before doing anything else. Step 2. Max out your Roth IRA. $7,000 a year. Early in your career, you're likely in a lower tax bracket than you'll be at your peak. Every dollar that goes into a Roth right now locks in that lower rate and grows completely tax-free for decades. This is where the Roth's advantage is most powerful. Step 3. Go back to your 401k with whatever's left. The annual contribution limit is $23,000. If you have more to save after the Roth, this is where it goes. That sequence, match, then Roth, then more 401k, produces more after-tax wealth over a long career than choosing either account exclusively. It's not flashy. There's no hack. But the math doesn't need to be exciting to be correct. The one question that cuts through everything. Derek and Ryan both thought they were making the smart play when they walked into their HR offices at 28. Derek thought free money was obvious. Ryan thought tax-free growth was obvious. Neither was completely wrong, but neither had worked through what their choice would actually mean in taxes, flexibility, and real dollars at the end of the line. The real mistake isn't picking the wrong account. The real mistake is picking without understanding what you're actually trading. A tax break now versus a tax break later. Knowing your rate today versus gambling on your rate in 30 years. Flexibility at 40 versus control at 70. Before you make this decision, or change the one you've already made, ask yourself one question. When do you want to pay the IRS? Today, when you know exactly what the rate is, or later when you don't. Your honest answer to that question tells you everything you need to know about which account belongs at the top of your priority list. And if you've already got money sitting in a 401k, and you're wondering whether it makes sense to move some of it into a Roth, that's a conversion conversation. The timing and tax strategy around that decision can be worth more than everything we just covered put together. But that's a story for another day.